The Bank of England holds steady, but will it keep calm and carry on cutting? The UK Central Bank offered little surprises today, holding rates at 4% and scaling back its government bond holdings. The message, though, remains cautious. Future cuts will be gradual and careful. Governor Andrew Bailey was blunt. We're not out of the woods yet. James Smith is developed market economist at ING. So, James, what are the dangers that the Bank of England see ahead?
Well, merely that inflation is still very high. It's pretty close to 4%. Could creep slightly higher from here. Certainly, it's going to stay above 3.5% for the end of the year, into the end of the year. And that's uncomfortable territory for the Bank of England, particularly worried about food inflation, which has been pretty picking up recently. And of course, after 2 or 3 years of very elevated inflation, they are worried about that staying higher for longer. So that's why the bank is becoming more reticent to cut rates. I still think further cuts are coming, but the prospect of another move later this year hangs in the balance.
So what is your timeline for rates now and for the rest of the year?
Well, I've long felt that this sort of quarterly pace of 25 basis point cuts would continue into next year. I think the August decision, which was more hawkish than us and many others had expected, makes that feel a little bit less likely. I think November, it's probably 50-50 right now. I think if we are going to get another cut this year, it does rely on the next set of inflation data looking a little bit better, particularly in the service sector, which is a key focus for the bank. I think the budget is also important for the bank as well. That is going to see big tax rises. That is going to be more restrictive fiscal policy, points to a more expansionary monetary policy, but that might be more of a story for next year. So yes, I think we have got 2 or 3 more cuts coming. Whether or not it's this year or into next year now, I think is more questionable.
The slowing of QT was largely in line with forecasts, but one MPC member voted for no change and another favoured an even quicker slowdown. Why the uncertainty?
Well, I think overall that 70 billion decision for the balance sheet unwind over the next 12 months, I think that was largely as expected. The bank doesn't want to rock the boat with this policy. It's supposed to be something that very much happens in the background, and it's pretty predictable. It doesn't want to cause market disruption as a result of this. So I think the decision wasn't that surprising. But I think the bank is getting closer to the point where bank reserves are at a more equilibrium level. So as time goes on, I think these decisions get harder. The balance sheet is getting closer to that longer term level.
Meanwhile, long-dated gilt sales are being limited to minimise the impact on the turbulent bond markets. Will this have the intended effect?
Well, I think at the margin, yes, certainly very long-dated UK gilts have been falling out of fashion over the last year or so, as they have been in other key developed markets as well. I think the much bigger driver for gilt markets now is what happens as we go into November's budget. Do we see those tax rises coming through? Or do we start to see, tweaks to the fiscal rules or something which investors are very sensitive to? So I think that's the much bigger driver for gilts going into year end.
So finally, James, the market reaction has been fairly muted today, but what's your outlook for the pound with the Bank of England on alert?
Well, as I say, we are looking for 2 or 3 more cuts from the bank. That's more than what's been priced by financial markets. We do think as well the budget, one way or another, will be negative for the pound. Either, as I say, we get big tax rises, that points to cooler growth, lower inflation, and therefore lower rates. So that's sort of, at the margin, weaker for the pound. Or we get more pressure on the bond market coming through, which is also weaker for the pound. So we're probably looking at for some more gradual weakness coming into next year, maybe euro sterling heading up to sort of 88, maybe an extreme 90.
That was James Smith from ING. Don't forget, you can watch more videos on Reuters.com.